Elections don't just change politics. They change markets. They move trillions of dollars across the globe. Every 4 years, investors start asking the same question. What will happen to my money? With Donald Trump currently in the White House, what could that mean for your investments, your savings, and the global economy? This is not about political opinions. This is not about supporting or opposing anyone. This is about understanding risk, opportunity, and strategy. Because smart investors don't panic. They prepare. Let's break this down calmly and rationally. The current economic landscape. To understand the future, we need to assess the present. Since Donald Trump took office again, U.S. markets have seen both volatility and resilience. Tariffs implemented across key trading partners have rattled parts of the stock market and tightened trade flows. At the same time, despite geopolitical tensions and policy shifts, major indices like the S&P 500 remain near record levels as investor optimism around AI investment and productivity gains supports valuation. This environment is complex: aggressive trade and industrial policy on one hand, and solid corporate earnings and macro fundamentals on the other. Markets don't move because of personalities. They move because of policy expectations. Policy and corporate profits. One of the defining features of the current administration's economic agenda has been pro-growth tax relief, deregulation, and incentives for private sector investment. When corporations can keep more of their profits, earnings per share often improve. Financial report earnings per share close up. That can result in higher dividends, more stock buybacks, increased capital for expansion. But markets often price in expectations before policies are fully implemented. By the time economic data is released or legislation is passed, much of the optimism, or fear, is already reflected in asset prices. Smart investors don't wait for headlines. They analyze probabilities. Sector rotation in 2026. Sector rotation in 2026. Not all sectors react the same to policy. Under the current administration, capital has flowed into technology and AI-related industries, energy and manufacturing, certain financial sectors. This is because deregulation and targeted investment incentives make these areas more profitable. However, sector rotation is temporary. Broad diversification, rather than perfect timing, builds long-term wealth. Trade policy, tariffs, and volatility. Trade policy has been one of the most visible sources of market volatility. Tariffs on key trading partners have created short-term market swings and uncertainty. Volatility does not equal danger. Volatility equals uncertainty. And uncertainty creates opportunities for disciplined investors. Short-term traders may struggle. Long-term investors often benefit when markets occasionally pull back and offer discounted entry points. The US dollar and interest rates. Political shifts can influence currency markets and monetary policy expectations. The appointment of a new Federal Reserve chair and speculation around interest rate direction have shaped bond yields and currency valuations in 2026. Currency strength influences commodity prices, emerging market performance, global trade dynamics. This is why global diversification matters. Not prediction. Diversification. What you should actually do. Now we arrive at the most important part. What should you actually do with your money? Here's the honest answer. Very little. Serious long-term investors do not radically change their strategy because of election cycles or a president's identity. They stay diversified. Continue dollar-cost averaging. Maintain emergency funds. Rebalance portfolios when appropriate. The worst strategy during political uncertainty? Going all in on one outcome. Markets are complex systems. No single politician controls global capital flows. Historical perspective. Over the long term, U.S. markets have grown under administrations of both major parties. The general trajectory of global equity markets is upward over decades. Because markets respond to innovation, productivity, demographics, technology. Not merely political headlines. Elections create short-term noise. Time creates wealth. The psychological trap. The real danger during periods of political and economic uncertainty is not policy. It's emotion. Fear-based selling. Overexposure to news. Speculative betting. Financial media thrives on dramatic headlines. But wealth is built through quiet consistency. If your strategy only works under one political outcome, it isn't a strategy. It's speculation. Risk management. Instead of trying to predict political outcomes, focus on what you can control. Emergency savings covering several months of expenses. Broad ETF exposure. Balanced asset allocation. A long-term mindset. Political uncertainty becomes less intimidating when your financial foundation is strong. Final thoughts. You cannot control elections. You cannot control headlines. You cannot control short-term market swings. But you can control your savings rate, your diversification, your discipline, your time horizon. Smart investors don't invest in politicians. They invest in businesses, innovation, and time. Elections and policy shifts create noise. Strategy creates wealth. If you value rational, long-term financial thinking without panic or hype, consider subscribing to the Money Code. Because in uncertain times, clarity is your greatest asset.